Nigerian research firm Proshare has released a report on Nigeria's Tier 1 banks. It's titled The Case for Redefining Tier 1 Banks and appraises the approach to tier-based classification of banks and offers a testable methodology as an alternative. And we love to get into stuff like this. Joining us to discuss further, AdbulQudus Isiaka, who is an economist, who's an analyst with Proshare. Abdul, you're very, very welcome. Thank you so much for joining us. So,
thank you for having me.
Great to have you here. All right. The report, I love that it says that total assets aren't enough when it comes to assessing tier-based classification of banks. Why is that? Because I'm a proponent for total assets. So you tell us why that's the case.
Well, the interesting thing is that by total assets, you're talking about a variety of things.
Right.
Variety of financial statement items. Talking about risk assets.
Yep.
I mean, you're talking about fixed assets, you're talking about intangible assets, different types of assets that really may not necessarily imply on the bottom line of the bank, and don't affect net interest income or even non-interest income directly. And so we want to look at, those metrics that imply more directly on the bottom line of, because again, and I think possibly going into, further into this interview, we'll discuss more about what a Tier 1 bank really is.
Right.
I think there's this tendency to conflate the SIBs and Tier 1 banks.
That's when you say SIBs, for the purpose of our
systemically important.
Systemically important banks. All right, great stuff. Let's put up a quote from the report. We pulled this. I want you to talk to us about the Proshare Banking Strength Index. Yeah, the Proshare Bank Strength Index lays more emphasis on efficiency metrics. This means even though a bank has large total assets, I think as you just said, on a statement of the financial position, this will not count for much in assessing its Tier 1 credentials. So that's fleshing out what you just said.
Yeah, absolutely. And so I think a good place to probably start from is, that methodology existed before our report.
Oh.
So, we went far back as 2013, there was an AfriInvest report, special banking report, that kind of set the basis for this FUGAS or FUGAS paradigm that we have, which actually stands for First Bank, UBA, GT, Access, Zenith, and ETI, if you would.
Okay.
And so that particular methodology, although raised the level of discussion at the time, requires, in our own view, a relook after 10 years. It's almost a decade, know. So we're taking a second look at it, and we're actually putting forward those particular metrics that we think speak to profitability of a bank. And this is why it's necessary. You see, and, the idea that SIBs are necessarily Tier 1 banks, I think, is erroneous. Because a bank may not necessarily be, an SIB to be a Tier 1 bank. So whereas the Basel methodology, which forms the foundation of the SIB requirements, speak to the concerns of the regulator, we're looking at concerns for investors. And that's why, as arbitrarily as, we've had the definition of Tier 1 banks over the years, the Tier 1 tag or the Tier 1 label has been a major, determinant of which banks get, the big ticket transactions.
Right.
And so, so in 2013, we had total asset threshold of 1 trillion.
Okay.
By 2020, in a subsequent edition of this same report I quoted, we had that requirement raised to 5 trillion.
Right. Yep.
Now, are we trying to edge out some and just favor some? What's the basis?
Gotcha.
And that's really the question we're asking.
Right.
And so it's an open discussion. Our idea at Proshare is that banks should be Tier 1 for now, and not for good.
I get where you're coming from. I see it, and you're rejigging the. Okay, so you know what? Let's look at the metrics themselves. These are technical. Let's take a look at the list of the metrics. All right, there we go. Let's walk through our viewers through this stuff. You've got the ranking metrics that you used over at Proshare. So let's do this. Capital adequacy ratio, non-performing loans, liquidity ratio, and I like the last one. I especially like the last one, the board gender mix, because we need more of that. But let's start at the top.
Okay, so let me say first that these metrics or
it's not exhaustive.
It's not exhaustive, but they weren't arbitrarily selected.
Okay.
I think that's one thing that we need to point out, and we try to do so in our report, right? So we actually came up with what you call a parsimonious ROA model, a multivariate model.
And again, for our ROA, return
ROA, yes. So we're trying
assets,
to,
right?
yes, we're trying to. We collected an awful lot of data, right, on different metrics different performance ratios, and we try to regress that against long-term profitability. Okay. How much do they determine the profitability of banks? Because don't forget, as I said earlier, we're looking at the implications for the investor, not for the regulator. And so we're not concerned about 6% of industry credit, 6% of loans, 5% of industry assets. No, we're not bothered about that. We're bothered about how much you're able to come up with, for your investors. And so to go to these metrics that we employed at the end of the day, based on our model, right? The capital adequacy ratio looks at how much cover your capital, tier 1 or what you call your core capital, and your tier 2 capital provide for your risk assets, right? So it's like an indication of how solvent the bank is, really. Then your non-performing loans ratio, we're looking at those, we're looking at the portion of your loan book that's still sound, really. We're not looking at those portions. And that's why, if you look at many Nigerian banks, their shares are trading at below their book value. That's because the market doesn't trust the valuation of their assets, majorly because, some of them are impaired. And so it speaks to the quality of the loan book, and that's why, you probably have non-performing loans there, as a measure of the quality of your loan book.
Makes sense.
That's two. Then liquidity ratio tells you about, the portion of, you want to look at the ratio of your liquid assets, highly liquid assets, to your liabilities. So how well the bank is able to meet its short-term obligations is what that we'll be looking at. And
just real quick, and we slosh this around because we have been asked. Liquidity is just the ability to be able to turn to cash, right? As quickly as possible. All right, okay.
And then finally, as I'm happy that it also tickles your fancy. But gender mix is a big deal because there's tons of reports. Proshare has reports on it. And McKinsey has reports on the role that having a balanced board has
on the performance of the financial institution,
especially the long-term profitability of the bank. So
great stuff. Nice, very nice. All right, we've got another excerpt here from the report. It was kind of like reading a novel. One important observation Proshare analysts made is the fact that bigger banks have generally maintained lower loan-to-deposit ratios, the LDRs, and necessarily higher effective cash reserve ratios, CRR. The fact that larger banks tend to have larger deposits means that ranking based on LDR and effective CRR would be rigged against the bigger banks. Go ahead and explain that.
Well,
that kind of makes sense.
I think
that actually
it makes sense.
It does.
I think it's plain, really. Because larger banks have larger deposits. And then to meet up with the 65% threshold.
For the loan-to-deposit ratio.
Exactly. That's like the prudential requirement. Okay, so to meet up with 65%, they need to lend more than smaller banks that have smaller deposits. So it's really simple. And what you find is
you lend more, you're impacting the cash that you have on hand.
Exactly. And so you're exposed again. So,
So I like that and then that's from the regulator.
Exactly.
Speaking of the regulator, let's take a look at this his next excerpt. Meanwhile, yes, analysts have questioned the regulator's frequent CRR debits, which altogether seek to penalize banks for not meeting their lending requirements, that's LDR again, but fails to take into consideration the fact that larger banks are in a catch-22 as they must also avoid exceeding the non-performing loan limits associated with creating the risk assets in a bad economy. So you are saying in your report, the bigger banks are boxed in.
Well, effectively, we're saying that they have a tall ask, and it takes more than average credit risk management to be able to ensure credit performance. The Nigerian banking industry recorded 5.7% above prudential guideline MPL, industry MPL in October 2020. That improved to 5.3% in 2021. By December 2021, we recorded for the first time in a long time MPLs lower than the prudential guideline of 4.8%. But then again, it didn't last for long because it soon rebounded to 5.3% again in April 2022. So that just tells you that it's a tough place to do business for commercial banks, really.
The report also talked about banks being under pressure to lend, which of course led to higher NPLs and then an extension of regulatory forbearance during the COVID pandemic. Are you suggesting that could have been avoided had they not been under pressure to lend more?
Well, I wouldn't say, because we need the real sector to get as much access to funds as possible as they can. But I think, I mean, it calls for credit risk management. It calls for being up to the task, really. If you are going to be extending or advancing loans, you should also be ready to manage them.
Yeah.
So that's the point we're making. Basically.
I'm glad you mentioned credit risk, because I want to put up the fact that the report did not, that is for 2021, it didn't include credit ratings. Why is that?
Well, at the time we were compiling or were rounding off the report, we didn't have, the data on credit risk rating wasn't available for all the banks. For, the data wasn't homogeneous, let's just put it that way, meaning that it wasn't uniform. We had for some years and for different years for different banks, and we didn't want to make a comparison that wasn't going to be meaningful.
Right.
We wanted a comparison, but in subsequent editions, of course, we'll be including credit rated. We will be, of course, we'll be exploring the data on credit rating more.
Fantastic. Credit is one of the, you've put in here, the 4 C's. It sounds almost, I don't know if it's religious or it's not, but yeah, can you talk about the 4 C's? Let's put up the 4, I hope we have the 4 C's. Capital, credits, culture, there they are, and control. Yeah, so talk about, how important are these?
Yeah, of course. I mean, the idea behind lending generally is, you want to manage your risk, and you want to ensure that the culture is in compatibility with, what you want a match or a fit. Okay, so there's a fit between what the economy requires and what you're lending to. So we're finding oil and gas lending when the world actually is pivoting, the global economy is pivoting away from that. So you want to make a fit. So basically, you're looking for a fit in terms of your lending, and then in terms of control. And I mean, as I mentioned, it's important for you to keep up to the task of lending, and that basically is by credit control. You don't just want to keep up lending and you run out of liquidity, or you are running, or you are having to make provisioning that's outrageous. We're seeing for some banks, we're seeing impairment charges so outrageous. You're seeing loan loss provisioning that enormous. And really,
I know it was in the report. We didn't want to put it out there. We just, if anyone wants to, anyone wants to read the report, can go see which banks you were talking about. I'm sure the curiosity will be piqued. All right, very quickly, will we see a Proshare FinTech Strength Index? Are you going to ever, because I'm sure this is every year, you're going to be doing it for the banks every year. So what about FinTechs? I mean, which I can understand that would be a little complex. Well, what do you think?
I mean, the challenge really is that, unlike banks that have their financial statements out there, and you can more easily assess, their performance from time to time. It's not quite the case with fintechs. It's quite clandestine for now. Maybe if we have more regulations in that regard,
then we can. Fair point. All right. Finally, you mentioned technology in the report. How do you see how it's impacted banking, finance, and so on?
Yeah,
and so forth?
I mean, the impact has been enormous. I mean, from the more trivial issues like banks adopting chatbots. We're seeing Ivy, Fidelity, we're seeing Leo, UBA, and a host of different types of chatbots, trying to ensure that consumer experience is enhanced. So, I mean, the fact that they're doing so, I mean, suggests something about where technology is taking the industry. That's one. Number two is that we're seeing digital income in most banks increase. And that shows that banks are beginning to diversify their P&L and their earnings, and they're de-risking their bottom lines, therefore. So, I mean, that's also a very interesting observation we made. I think besides that, you also recognize the fact that, banks are also beginning to step up to the challenge of, having Momos. I mean, they're also having to have their own agency, their own form of agency banking, like First Money and the like. So, I mean, generally, it just tells you that brick and mortar banking is on its way out, really. We're going to be seeing more digital banking. I mean, and again, I mean... We
actually have to go. Okay, we got to go. But Abdul, we're going to bring you back. AdbulQudus Isiaka, analyst with Proshare. Fantastic report. It was a great read. We'll have you back, all right?